Okay, good afternoon, everyone. Welcome to another training video on tax tips for real estate investors. My name is David Wu. My areas of focus is in real estate tax, retirement income planning, and financial risk management. Before I begin, I'd like to start by telling you about my Realtor Alliance program. So, this program gives free tax consultation for realtors and their clients um, with 100% client confidentiality. As well, I will not be soliciting your clients or referring them to another brokerage or a realtor. Okay, so if you're also a brokerage, I do offer free tax seminars for your brokerage for your realtors to provide some free training for your realtors as well. So do feel free to contact me to get more details, and I encourage you to take advantage of this service for free initial consultations for your realtors and your clients. Please contact me at the information below to get started, and we'll take it from there. Okay, so back to today's topic, tax tips for real estate investors. So I'm going to go through a short video on some of the considerations that you should think about as a real estate investor. Okay. Now, I'm only going to focus on individual investors as opposed to people who incorporate. Okay, we can leave that to another video. Now, if you're an individual and you buy a property to rent out, you will be reporting your net rental income on your personal tax return on a form called T776 Statement of Real Estate Rentals. So I want to highlight some of the common expenses that you can expect to be able to claim, as well as some of the pitfalls to be careful about. So if you are a real estate investor, you're reporting your rental income, you are eligible to claim such expenses to reduce your net income and ultimately reduce your taxes payable. So I've made a list of some of the common expenses there. I'm not going to read out each one. I'm going to focus on a couple of them. So one of them I really want to touch upon is mortgage interest. A lot of people make the mistake of claiming the mortgage principal as well. So this is where some confusion comes into play, where if you're an investor, you're looking at whether your property is making positive cash flow or negative cash flow. Unfortunately, cash flow does not mean is not the same as rent, net rental income. Because cash flow includes mortgage interest and mortgage principal. But for tax purposes, the CRA only allows you to claim mortgage interest. So you could be in a situation where you are having a break even or a slightly negative cash flow. However, you still need to have pay taxes because you have positive net rental income. Okay, so just be careful not to claim the entire mortgage, only the mortgage interest component. Okay. Um, Another area I want to mention is know the distinction between maintenance and repairs versus capital expenditures. So this is very important. If there's painting the house, doing some repairs, some maintenance to put the house or the building back in its original condition, then that's repair. You can claim your repair in the year that you spent the money. Capital expenditures are major renovations, upgrades. You decide to replace the entire roof, for example. Those items you cannot claim on 1 year. Those needs to be depreciated and claim over several years. Okay, so um, you'll need to apply capital cost allowance or CCA to claim, depending on the type of capital expenditure it is. You have a certain percentage that you can claim every year. Okay? And it's optional to claim CCA. So I'm going to circle back on that topic in the next couple of slides. So just know the distinction between maintenance and repair versus capital expenditure. Main difference is capital expenditure. If it's something that's going to be class more of an upgrade, totally replacing the roof, um, you're doing building a new a basement, for example, then that'll be capital expenditure. You cannot claim that in the year that you spend the money. Last thing I want to highlight is in red, land transfer tax. So oftentimes clients make the mistake where they claim the land transfer tax as a rental expense. Okay? So land transfer tax cannot be deducted as a rental expense. However, what you can do is when it comes time to sell your property, land transfer tax would be part of your acquisition costs. So that would be part of the cost of your property. So by doing that, it will reduce your gain when you sell, and because your gain is lower, your taxes will become lower as well. So land transfer tax is treated at the time of sale. It's going to increase your cost base, which because your costs are higher, your taxable gain would be lower. So that's how land transfer tax is handled. Uh, a special expense that I want to mention is on motor vehicle expenses. So if you're a real estate investor and you have access to a car where you're driving to the property, depending on whether you have one property or more than one property, uh, this will impact what you can claim as motor vehicle expenses. So motor vehicle expenses includes gas, insurance, maintenance, uh, and repairs. So if you only have one property, so let's look at a situation you only have one rental property. You cannot claim motor vehicle expenses if the sole purpose for driving was just to collect rent. Okay, so you cannot drive your car to collect rent and then claim those motor vehicle expenses. As well as the property needs to be in the general area where you live. Okay, so that's another important thing is if you only have one rental property, in order for you to claim motor vehicle expenses, the property needs to be in the general area where you live. As well, you need to personally be the one doing the maintenance or repair work. So if you're going to be driving to the property and you want to claim motor vehicle expense, then you need to be the one to be doing the maintenance and repair work at the property. Okay. Now, if you have more than one property, you can claim motor vehicle expenses even for driving to collect rent. The property can be outside of the area where you live, and you can claim motor vehicle expense for simply supervising repairs and the overall management of the property. Okay, so you don't need to be the one doing the actual repair work. You can be supervising the repair and going to the building as part of a property management type of role. So keep in mind there's a difference between if you have one rental or two rental properties and impacting your ability to claim motor vehicle expenses. I should also mention that when you're driving a car that's also used personally, you'll need to keep track of the mileage that you use for the rental property and prorate based on that ratio of total mileage driven um, and then compare to the portion only related to your real estate rental mileage. That's the amount that you can claim as a percentage of your overall motor vehicle expenses. Okay, so you can't claim 100%. You need to make sure you keep track of your mileage. Okay, another interesting topic here is called capital cost allowance. So CCA is at a rate of 4% on the cost of the building. So what CCA allows you to do is you can claim 4% of the cost of your building, excluding land. Okay, so you want to make sure that you break out the cost of the building versus the land. Oftentimes, you look at your home insurance. There's gives you a breakout of the cost of the building, or you can get the appraised to get a more exact figure. But what the CRA allows you to do is you can claim capital cost allowance of 4% of the building each year to reduce your net rental income to zero. So you cannot make your rent income less than zero by using CCA. Only eliminate your net rental income so you don't need to pay taxes on that. So this will have the effect of saving you taxes from year to year, and it's optional to claim CCA, so you can claim it 1 year and not claim it the next. Now, what's the catch? The catch is that when you eventually sell the property, you'll need to add back the CCA as income. So, give you a quick example. If during 10 years time period you have claimed CCA of $10,000 a year, let's say, okay? Over 10 years, you would have claimed $100,000 of CCA. That's great because you get to defer, you get to really save your taxes for those 10 years. Now, when you sell the property, not only will you have to report any gains associated with that appreciation of the property, you'll need to add back the CCA as income. So that $100,000 that you've claimed in the past, you'll need to report as income. Okay, so there's a lot of real estate investors who uh, doesn't like that and decides to not claim CCA. So they avoid the whole scenario of having to deal with a big tax bill potentially when they sell the property. Now, there's no right answer to this. My my thinking is if you are in a very high tax bracket right now, okay, so if you're in, let's say, 50% tax bracket, every dollar of real estate income you make, you're going to have to pay 50 cents to the government. So if you're in a situation like that, it would be beneficial for you to be claiming CCA so that you can save taxes right now. So a dollar saved today is worth more than a dollar saved in the future. Now, if you are holding on the property in the long term, you can save many years of taxes by claiming CCA. If you plan it properly, when you sell, it may be a situation when you're already retired or you have a lower income. So yes, you're gonna have to add back the CCA, but you your savings each year would be more than offset the extra tax you'll pay in the future. So there's some planning involved, some forecasting to see, okay, the ideal situation is claim CCA when you're at the highest tax bracket and sell the property when you're at the lowest tax bracket. So this is, up for debate. So CCA is something definitely for you to consider, but everyone has a different opinion about this. So you'll have to, do some forecasting, work out the numbers to see if this is beneficial to you or not. Now, one thing I want to mention is that if you're a real estate investor, okay, CRA can treat your gains as either business income or capital gains. Okay, so here's the difference: business income, if you are treated as having business income from your real estate sale, 100% of that is taxable. Capital gains, on the other hand, 50% is taxable, which means 50% is tax-free. So, for example, if you made a capital gain of $30,000, if you're being treated as business income, you have to uh, include $15,000, sorry, the whole $30,000 as business income. On the capital gain side, you only have to include $15,000 as income on your taxes. So what the government looks at for this is if you're someone who buys a property and flips it or renovates it and sell it in a short period of time or have a history of buying and selling properties, they will most likely classify you as generating business income subject to 100% taxes. If you are buying for a long-term hold, renting it out, then chances are you will be more geared classified as capital gains. You got to be careful. Another aspect to be aware of: if you're a contractor or you work as a realtor, you're in a much higher risk position according to the eyes of CRA. So, very important to do some planning and understand what your tax obligations are. Okay. Lastly, I want to end off by summarizing again my Realtor Alliance program: free tax consultation for realtors and their clients, free tax seminars for your brokerage. So please contact me at the information you see below, and I'll be happy to give you more details. Okay. So with that, I would like to wish everyone a very happy and wonderful rest of the day.